Hi, Matt McAleer, Director of Equity Strategies, December 10th, just after the close. Solid week, bit of a bounce off of some of last week's pressure. Really, NASDAQ, S&P, Dow, all very solid, up close to 4%. Good broad strength as well. Last week, I promised we'd take a look at a couple of charts, just try to get an idea of where opportunity may lie within the market. So the first chart I wanted to take a look at is what's called a point and figure chart. And it doesn't matter if you're a bar chart person or a candlestick chart person or a point and figure chart person. What charts do is try to complement what perhaps your fundamental or macro vision is on any specific market, whether it be a fixed income market or an equity market. What charts do is try to follow supply and demand. So we like to use charts to give us an idea if the market is accepting our thesis on what we own. What you're looking at right here is a point and figure chart of the weakest index currently. What we see when we analyze this index is a long period of consolidation. Shay Slauson, one of our crackerjack traders here, put a yellow box around the recent market activity. What you see is a nice breakout to a new high at 240, followed by a pullback. And that pullback in the index is trying to create a higher low versus the previous pullback. My point being, this chart to me is fairly constructive. Now, by the way, we don't own this index, but it is of interest to us. What index are we looking at? Let's take a look at chart number 2. This is a 30-day snapshot of the 4 broad indexes we like to follow and that we talk about on our Monday and Wednesday trading calls. IWM, down about 9% over the last 30 days. Horrible relative strength. You know we're fans of relative strength. So obviously the relative strength is with the S&P 500 and the NASDAQ 100, which are, we'll call them unchanged over the last 30 days. What's interesting about IWM is that's the Russell 2000. That's the 2,000 smallest stocks of the Russell 3000. Been underperformers for some time. But when I flip back to chart number 1, what I see is a trading scenario that has not broken down. So if the worst index in the equity market right now is in a long-term consolidation, I have to lean bullish here. Now, that can change next week. But when I look at the worst index, and it hasn't broken down, it's pulled back off of an all-time high, I start to think, do I want to be involved in this index simply from a reversion to the mean trade? Right? Reversion to the mean trades are very popular historically late in the year. You've had a lot of tax loss selling here. This index has taken on a ton of pressure. We're heading into the back half of December and early January, which has been, again, historically, a nice spot to take a gamble on the small caps. So when we're looking for new ideas, and again, we don't own the Russell 2000. We have in the past, we don't today. But this index is very much at the front of our conversations. We can own this index through IWM, which is a ETF that gives us that full exposure. So often we talk about trends and relative strength and wanting to be in names that are working and indexes that are working. But at times we have to remain flexible enough to certainly consider that reversion to the mean trade. So we'll be discussing this in our meetings over the next week or two. I wouldn't be surprised for clients if you see this in your portfolio between now and year end. See if we can catch a little pop out of the small caps, and then we'll take another look at it as we head into January. Patty Healy is going to cover the credit markets. She's our senior credit analyst. And the Moose is on the road. Patty will fill in admirably. Have a great weekend.
Good evening. I'm Patty Healy, Senior Vice President of Research at Cumberland Advisors, and today is Friday, December 10th. The big news everyone was waiting for this morning was the CPI number, trying to look for clues to inflation. Well, the month-over-month number came out at up 0.8% versus expectations of up 0.7%. Meanwhile, year-over-year was 6.8%, exactly in line with what people thought. But 6.8% is still a high annual inflation rate. A lot of market participants, pundits discussing the rates and what the Fed might do, are anticipating that the Fed may taper sooner, or that there may be more rate increases than initially expected. But then, some more news about Omicron came out. There was not such a good payrolls number last week. The supply chain issues, some look like it's getting harder to deal with, and then there's some news that supply chain issues are getting a bit better and managed better. So it was kind of a mixed bag, and we'll see what happens. But the stock market reached new highs for some of the indices, and the bond market ended up pretty much where it was at the beginning of the week, with a 148 on the 10-year and about a 188 on the 30-year. Next week, the big number that the market is going to be looking towards, not number, really an announcement, is the Federal Open Market Committee on Wednesday afternoon will release its rate decision. And it's still expected that it will be in the same range that it is, 0% to 0.25%. But what will be interesting is to see the minutes of the meetings and hear what all the various, the Fed president would say, as well as all the other people that make comments after the meeting, to see whether the Fed's still thinking that there's any transitory effects going on in inflation, or if it's real. I wanted to encourage people, if they'd like to, go to cumber.com and look under market commentaries, a December 5th commentary by Robert Eisenbeis. He's our vice chairman and chief economist, and in his previous career he was the director of research for the Atlanta Federal Reserve. He has a commentary in there. It's not very long. It's called Uncertainty, and it's about numbers that came out, all the numbers that the Fed needs to look at. Interestingly, it talks about the payrolls number and how the Fed looks at different sectors to see what's really going on, and looks at the numbers in their own way, maybe not overall like some of us may at time to time. And it's very interesting, very straightforward, and at the end of it, there's a lot of uncertainty, a lot of changes to look at, and not that many good options. So I think you'll find it interesting. So we'll see what happens next week. Just on the Muni market, municipal market, munis remain in demand, though their yields also ended up pretty much where they were at the beginning of the week, with a 1.03 on the 10-year and a 1.48 on the 30-year. The Muni Treasury ratio declined, so that's not as good for investors. You want a higher Muni Treasury ratio so that you have an taxable equivalent yield higher than the taxable rate. So ratios went down, which is, strong demand was coming for the munis. Basically, munis have good credit quality. There's still the fear that higher taxes are coming our way, so that makes munis in more demand. And surprisingly, next week the calendar is somewhat large historically. It's at about $7 billion. It's very close to the holidays, and usually people are not doing that many transactions. However, rates are still low, and it looks as though advanced refundings will not be allowed in the Build Back Better program. So a lot of issuers may have been waiting for the ability to do a tax-exempt advanced refunding. Now that seems like it's not going to happen. They're kind of coming to market now to take advantage of what is usually a lower time and the currently strong demand. So a little bit on Muni credit quality. Right now, Munis are doing fairly well. They've gotten the substantial stimulus and they're having record revenues come in. However, they're actually, they have a lot of expenses as well. Just need to watch out going down the road that they're not increasing budgets that future years' revenues won't be able to cover. So that's, for right now, things are good, and most of the Muni credit quality community is looking at that, and I think issuers hopefully are looking at that as well. I thank you and have a great weekend.